And just to say thanks very much for setting up this session. For those of you who don't know anything about Gowling, or Gowling WLG is also known, we are a full service international law firm. We have offices in London and Birmingham, and we've been a long-term proud sponsor of the Hereford and Worcestershire Chamber of Commerce, so we're delighted to be with you this afternoon. Both Sean and I are part of our trade team, and as you can imagine, we've been very much focused in the past couple of months on helping businesses to prepare for the upcoming changes that will kick in on the 1st of January. Now, as I'm sure we are sort of hearing as the press releasing sort of different stories minute by minute, actually what that trading relationship with the EU will look like on the 1st of January is still yet unknown. And we'll come back to a couple of comments around that and what the timeline looks like. So yeah, Sean and I, as I said, we're delighted to be here, and we'll just start now with our discussion, and please do chip in with questions as we go along.
I'm hoping also everybody can see the slides as well on the screen. Good stuff.
Yeah.
Cool.
So what we'd like to cover over the next 40 minutes or so is to give a short update on the status of the EU negotiations. We want to consider what the different, or what's the nuance would be for traders between a deal and a no deal situation. And we also want to spend some time looking at the new border operating model that will kick in on the 1st of January, because I think for businesses, in terms of the practicalities of preparing for Brexit, for the end of the transition period, this is sort of the most important piece to think about right now.
Yeah, so in terms of where we're now, I mean, we've just had it confirmed in the last 20 minutes that the government is breaking the law with its new proposal. So that's something fun to look forward to. But essentially, we are still in free trade agreement negotiation territory, which is kind of set out in the political declaration that was agreed last year, with the 8th round of negotiations beginning today and taking place this week in London. As alluded to, there are a number of areas that are still not yet agreed, and it's looking like there may not be a deal come the end of the transition period on the 31st of December, with Boris Johnson himself saying, if we don't have a deal by the 15th of October, then no deal's not a bad outcome. Debatable. And yeah, so as I mentioned, there's recent news coverage suggesting that the UK government is seeking to override the withdrawal agreement, and Brandon Lewis in Parliament has just said that the UK will be specifically breaking the law in this respect, but we will wait to see what's published in terms of legislative proposals for that. And that is a reference to the UK's internal market, which is a legislative proposal to essentially ensure there are no barriers to trade within the UK as between Great Britain and Northern Ireland. And the kind of background to the controversy there is that in the Northern Ireland Protocol, which was agreed as part of the withdrawal agreement, as part of the legally binding section, is that there should be no customs duties payable on goods moving between Northern Ireland and Great Britain, unless those goods are at risk of subsequently being moved to the EU after they've been moved from Northern Ireland to GB, or if they're imported into Northern Ireland, there'll be a UK tariff applicable unless those goods will subsequently moved into EU after having entered Northern Ireland and therefore the UK. There was also an agreement that the EU state aid rules will continue to apply in the UK for measures which may affect trade between Northern Ireland and the EU. So although it's specific to that aspect of trade, they do apply within the UK. And against that backdrop, the UK government is now trying to allegedly renege on what it's agreed here, and is expected to propose a new UK state aid regime, whereby devolved administrations, the Scottish, Welsh and Northern Ireland assemblies, will be involved in administering state aid law. It's not yet clear what that will look like. And also it's expected to prevent any need for customs declarations or the levying of customs duties on goods that move from Northern Ireland to GB or vice versa, seemingly irrespective of what it says in the Northern Ireland Protocol. And that bill, the UK Internal Market Bill, is due to be published tomorrow. So we will have more detail there on what exactly that will look like. I don't know, Esther, if you had anything else to add on those couple of slides.
No, and I think, I mean, just from looking at the EU-UK negotiations, just that the sticking point is obviously that we have key concerns from the EU around state aid and fishing access, and the challenge for the UK is trying to persuade the EU to move forward with negotiations on other elements of the trade agreement that would hopefully be able to mean that we can still keep to a timetable of having a deal in place by the end of the year. But the EU has been very much taking the approach it has to be step by step, so we won't move forward with agreeing chunks of text while still big other issues are outstanding.
So this section, we just look at the difference in what will happen if there is a deal, or what does that mean, and what does that look like in terms of your preparations versus what if there isn't a deal?
Yeah, so very broadly, in the event of a no-deal Brexit, and I'm sure this is, this is something that has been discussed and been sort of in the public arena for a number of years now, is that the UK will trade with the EU on what is known as World Trade Organization terms. So that means that we trade with the EU as a third country and as mutual members of the WTO, as if the EU were the US, for example. So the UK, the US, or the EU and the US, we have no existing trade agreement in place, and we trade with them on what is known as WTO terms. So you can expect to pay duties on goods that you want to import from the US, and likewise, if you wanted to sell goods onto the US market, you would expect them to be subject to duties when they land in the US. What we do have is, within that World Trade Organization framework, is the UK has a schedule of tariffs that it must commit to, so that it must be consistent in how it levies tariffs against other WTO members other than those with which it has a trade agreement, and they must be within predetermined limits. So the UK doesn't have a huge amount of flexibility to move outside of those that actually the EU has already had in place under that agreement. What it does mean is we would have full customs declarations required between trade between the EU and the UK both ways, the same way as we do with trade with the US today. So you can expect checks at the border, and obviously HMRC being active in collecting customs duties and ensuring that you're compliant with all the import and export rules. From a VAT perspective, looking at how we trade with the EU today, we're used to a system of acquisition VAT. So if we buy goods from the EU, we account for the VAT locally in the UK, so they can dispatch with zero VAT. But moving forward, we would move to an import VAT regime that we'll touch upon later on. What do we see as the key challenge under this regime? Well, I think it's really that if you're trading with the EU both ways, is there will be a push from the European Commission, from the UK government, to ensure that the duties are fully collected on all the goods that we trade, to make sure that our revenue is protected. So I think traders can expect a high degree of scrutiny from HMRC to ensure that the import declaration that it files has all the right data elements within that, so that they can be confident that they are collecting the right amount of customs duty. Flip forward. So what's the difference? What would we see in the event the UK-EU strikes a trade agreement? Well, the EU and the UK, they set out their political declaration was to land on a trade agreement that would give broadly a zero tariff regime between the two parties. And we think that that objective will stand, although albeit there will be some tariffs that may be levied on agricultural goods, for example, where we seek to protect our domestic producers. The main challenge about trading under a trade agreement is that it's not an automatic right to zero tariffs for goods that I ship to the EU. I must demonstrate that they qualify for preferential treatment under that agreement. I must ensure that what I'm selling into the EU market is classified as a made in the UK good. And we're going to come back to this later on in the presentation, but there's a number of rules that typically apply, and you must be able to make sure that you can demonstrate you meet whichever particular rule is relevant to your product, as well as some simple rules which say your goods must have undergone a minimum level of processing in the UK. It's not enough to receive, let's say, a set of ceramic plates from China, repackage those and send them to the EU and expect to have tariff-free access into the EU market. And because in order to trade under these trade agreements, because it is highly regulated, and both parties seek to ensure that there is no misuse of these trade agreements or circumvention of the rules to gain better at market access rate than you should be entitled to. So for example, for the example I've just used, to make sure that we're not just selling Chinese made goods onto the EU market without paying the proper amount of duty, is that there is a very quite detailed compliance process around using these agreements, which includes filing a customs declaration, as we will in a no deal scenario. Goods still may be stopped at the border, although under these agreements you typically have a better degree of cooperation between the customs authorities, or a commitment to better cooperation, which would hopefully reduce somewhat the need for physical stops at the border. And quite crucially is you will need to be able to provide a valid certificate of origin or a valid supplier declaration to your EU customers that say, I can certify that these goods meet the rules of origin under the EU-UK FTA and are therefore exempt from customs duties. So it's really going to be building in some extra compliance processes into your sales operations, and vice versa. If you're procuring materials as well, you'll be asking your suppliers to similarly to provide you with those kinds of statements. From that perspective, again, there's no provision under the trade agreement that would allow the UK to maintain maintain itself as a member of the EU VAT regime. So we move back to import VAT, and I think what companies will find is that the trade agreement is not some magic bullet. Yes, it should ensure that you don't pay duties on EU goods or UK goods going to the market, but the compliance challenge is the same as if you have a no deal Brexit, and I would probably argue actually it is actually more so. So I just want to come back to this concept of preferential rules of origin. So that is saying, how do I demonstrate that my goods qualify for this for the zero rate of duty in the other market? And there's 4 principal rules of origin. So we have wholly obtained, And that really applies to agricultural and mineral products. So it's something I've dug out of the ground, or it's livestock that I've that have been produced and raised in the UK. We have the regional value content rule. So that says that if you your product must have a minimum amount of UK accumulated value, whether that be from materials that you've used in the production, or the labour and the manufacturing overheads that you need to manufacture your product in the UK. It must have a minimum level of UK input. And the way that the UK EU FTA is likely to phrase this is to, rather than say, well, I need 60% of the value of the good needs to originate in the UK, is they will flip it and they will say the value of non-originating content must not exceed 40%, because it's a slightly easier calculation for businesses to make. The third rule that you will likely to encounter is something called a tariff shift rule. And quite simply, that is saying is that your good must undergo enough processes to mean that you imported, I'm going to say, a raw material. I'm going to take an example of, let's say steel, and you're going to turn that into a part for the automotive industry. So you've imported some steel and you're going to make a nut for the wheels. Is that you've done some processes. So it means when you imported that steel, it had a particular commodity code. So under the tariff that we all trade under, so all goods are assigned a 6-digit code, which means that at import we can identify the applicable duty rate. And what we're saying under this rule of origin is that you do enough processing in the UK to make, from when it enters as one code, that it leaves under another. And if anybody, as I'm going through these rules, I realise that they are complicated and they are quite sector specific. So you'll find that different sectors, that typically the rules for different sectors apply in a certain way. So if anyone's got any questions, please do let me know, or do feel free to follow up with Sean and I after this session, because it's not a particularly easy concept to run through in a presentation. And then the last rule tends to be quite, again, product specific. So they will give you a specific process that your product has undergone. And typically we see those in the chemical sector. So rather than saying, oh, you need to add 30%, you can't have more than 30% non-originating content in your chemicals. They'll say, actually, your chemicals have to undergo some specific process or chemical reaction in the UK to qualify for preferential treatment.
And I was just going to add as well, Ursula, that these preferential rules of origin will apply in trade agreements that the UK has with other countries as well.
Yeah.
So you can make efficiencies there in terms of being able to trace your UK origin, because that will be relevant to your ability to claim preferential tariff treatment under other agreements in the UK and other countries.
Yeah. And here I've just used an example of milk chocolate. So under CETA, which is the shorthand for the trade agreement that the EU has with Canada, in order for that chocolate to qualify as being of EU origin, so it has to be manufactured from ingredients, or it has to consist of an ingredient that has been manufactured from products that are classified under a different tariff heading. So I can't just import some sort of huge slabs of chocolate from, I'm going to say, the US, and then sort of re-chop them up into smaller bars. Now I actually have to like have some raw ingredients that I've then produce a chocolate bar. So I've got that tariff shift rule met. And then on top of that, there's another rule which says I can't use, I must use like I can't use more than a certain limit of non-local, so non-EU or non-Canadian sugar and dairy content. So this is sort of where businesses are going to have to think very carefully throughout their supply chain. Where am I sourcing from? Can my suppliers provide me with statements of origin as to what, you know, do their products in themselves qualify? What are they from? Where are they, you know, what are they made from, and where are they sourcing that content? And then in turn, thinking about the manufacturing process that my product undergoes in the country in which I'm trying to seek originating status. So as a law firm, where we're looking at these rules, which can be quite complex, and in turn you can get scenarios where it's quite a fine line where your product qualifies or not. We spend a lot of time with businesses trying to build a good case as to why their goods do qualify. And I think what we'll see is, if we do have an EU-UK agreement, is that we can expect certain sort of what I would call more sensitive sectors to be under quite a lot of scrutiny to make sure that UK exporters are meeting all the relevant rules of origin. I'm just going down. So I'm going to hand over to Sean to talk about the border operating model, but perhaps before I do that, if there are any questions, then just either come off mute or pop a question in the chat box. Okay, I think everyone's bamboozled. My work is done. John, do you want to go on to the border operating model then?
Yes, so the border operating model is it was published by the UK government in July, and it is the way the border between Great Britain and the EU will work after the transition period. There's a separate mechanism for Northern Ireland, which has yet to be fully detailed. So it consists of 4 different phases, really. So phase 1 being the end of the transition period, and suddenly the UK, we're no longer pretending that the UK is part of the customs union single market and everything proceeds as normal. And because of this phased approach, there is the ability not to have to submit custom duties or customs declarations at the point of import for goods between the 1st of January 2020 and the 1st of July 2020. So you can defer those up to 6 months from the date of import. And then it sort of gets increasingly more difficult to do this as time passes. So from April 2021, all products of animal origin, so if you're in the food sector, this will be relevant to you, or plant products, plants themselves, you need to pre-notify those to HMRC before they enter the UK, before they enter GB, I should say, from the EU. But again, there will still be no physical check at the border at that point. The physical check will be at destination of import. And then from July 2021, the border's kind of fully up and running. All traders importing and exporting between the UK, between GB and the EU, will need to make full customs declarations and pay applicable tariffs on import or export. And physical checks from this moment will begin at GB border control posts rather than at destinations. So there'll be physical inspections of those animal originating products. So split this section into two. So one for the import procedures where you're importing into GB from the EU, and then later we'll look at the difference if you're exporting from GB to the EU. So there's kind of two key points. So from the 1st of January, you will need import customs declarations when you're importing from the EU, which you don't need now. And tariffs will also be payable on goods unless there is a free trade agreement between the EU and UK saying that there is no tariff. There may also be reduced tariffs under a UK-EU free trade agreement. As I mentioned earlier, from January to July, you can elect to defer the submission of full customs declarations and the payment of tariffs. Although you don't have to, you can choose to declare and pay tariffs at the point of import. But obviously you'd lose out on a short-term cash flow gain by not deferring. And your role as a GB importer will depend on your contractual terms, so Incoterms that you would have with your seller. That will determine where your responsibility is in terms of completing customs declarations, paying any duty, paying any VAT. But unless you're purchasing on DDP terms, so delivered duty paid terms, you will be responsible for completing any customs formalities. So in terms of deferment, like I said, you can defer standard goods, so not controlled goods or excise goods. You can defer the submission of customs declarations and the payment of duty for up to 6 months from the date of import. So if you import something on the 1st of February, you can delay that for up to 6 months from that date, or 1st of January. But after the 1st of July, you lose that ability to defer unless it's extended by the UK government. But at present, there's been no announcement that they will do so. Things may change if COVID continues and we have a second lockdown. And one thing the government did note in the publication of the border operating model was that the phased approach is being introduced in response to difficulties businesses are facing from COVID. So possibly a second lockdown may lead to change in these rules. So yeah, these are kind of the key steps in the process if you are deferring. So you have a declaration by entering the current record saying that something is entered GB. And the GB importer will then need to be able to submit a full customs declaration before the 1st of July 2021, which will require authorization to use Customs of Freight Simplified Procedures, or CFSP. And to use those, you'll need to get a financial guarantee, usually from a bank or possibly an insurer, and that will give you access to using a kind of quicker way of submitting declarations. And you can either make those yourselves, or you can appoint a third party on your behalf to do so using your authorization. But if they do use your authorization, the importer themselves will still be liable, not the agent. So yeah, another key point is the importers will have a choice. You can appoint an intermediary, so a freight forwarder, agent, or broker to complete customs declarations for you, or you can do it in-house, and there's specialized software for doing this. And you'll also have to have required kind of checks and badges in place that enable you to do so. But in either case, it's the importer themselves who is liable for providing the correct and accurate information on the declaration to HMRC. And it's important that any trade documentation matches the information submitted on the declaration. Similarly, as I touched on this earlier, is that each product in the world essentially has a commodity code, and that commodity code is important for determining the applicable duty that would be payable, if any, on the thing you're importing. So it's important to maintain a record of those commodity codes and declare those correctly, because failure to do so could not only land you in trouble with HMRC, but also land you in financial difficulty, because you may have to pay a different higher rate of duty if you got it wrong. You should also be keeping proof of import, so those declarations and transport documents, even if you've appointed an agent to do so, so that you've got everything underlying it in the event that you do need to demonstrate anything to HMRC. The key point, and this applies whether or not there is a UK-EU trade agreement, is it's really important to maintain good records of what you're importing. You need a description of exactly what those goods are, the weight, size, etc. Commodity codes I mentioned, origin of the product, and the value, because these are all the figures that will be used to determine the applicable duty and whether you may qualify for preferential tariff treatment under any UK-EU free trade agreement. You also need to keep any relevant trade and transport documentations and the unique consignment reference number as well. And if you do come to apply for CFSP authorization in the future, before 1st of July, you'll need to demonstrate that you have sufficient record keeping processes and procedures in place to obtain that authorization. Another thing, so if you are a regular importer or you've got specific needs, you can use custom special procedures, some of which I've set out in this slide. So it depends on, so for example, customs warehousing, you can store things temporarily in a warehouse without needing to pay duty, excise tax, or import VAT, and you pay that when they leave the warehouse. And similarly, you've got inward and outward processing if you're taking things from GB into EU and vice versa, to put new things together.
And Sean, I'm just going to refer to an important point under inward processing that someone's just raised. One of the challenges for using inward processing in the context of a trade agreement is that there's typically a rule within the trade agreement that's called the no drawback rule. So it essentially says you can't take the benefit of a duty of having of the duty suspended if you're going to re-export the goods using a trade agreement, because if you like, you're sort of double dipping on the benefit, and your goods have never really been in sort of UK free circulation, and so it's difficult to say can they count towards the originating content. So different, and some trade agreements they say supply rule only apply to certain HS harmonised system chapters. So I suggest that where you have a particular supply chain scenario is that you take a sort of a look at that on an individual basis. It's not a sort of a blanket rule, and it could be a question of working out, sort of calculating whether there's a benefit to using your IP authorization, or rather than moving to a scenario where you're just solely using the trade agreement. It will depend, I think, a little bit on what your outbound markets are.
Good point. Anyone else, do you have anything else to add on this slide before I skip?
On customs specific features, not really. I think the only one I would add, which I think is important, is temporary admission. So sometimes you'll see that people bring goods in and out of third countries using what's called an ATA carnet, which means that you don't need to have a full customs declaration. You're purely bringing an item in for a trade fair or a demonstration, and then you bring that item back out again, and you just need to keep a trail of paperwork so that it's clear that you haven't tried to then make a sale of those goods on the local market.
And the other thing that's changing is VAT. So instead of being acquisition VAT, it's now import VAT. It's possible to postpone the accounting from the 1st of January 2021 and defer this until the full implementation of the border. But as I think we discussed this earlier, we don't think this will have a big impact in terms of cash flow. It's more of an accounting process that will be changing.
For most businesses, I think the only thing that we need to think about is if your business was, for example, mostly an exempt business, that may change your rate of recovery. So if you make exempt supplies, but that again is quite sector specific, it's something that would need to be thought out on a case-by-case basis. I'm just conscious of time, and I just wanted to so we have got a lot of very interesting questions that I just think would be worth covering, just to ensure that we're doing what we promised to do. There was a question on CE marking, and CE marking was what is the current conformity assessment regime sort of used by the EU. We're moving to something called the UKCA, so that's the new product marking system that's used for sort of certain categories of goods. I think it will broadly operate in the same way as CE marking. I think the point that you need to be mindful of is that if you intend for your product to be placed on the Northern Ireland market, I understand it will have to bear both CE and the UKCA mark. So that's something just to be wary of. I also think that there's a transitional period applicable for CE marking, so that it's not on the 1st of January you have to move to UKCA, that actually you can continue to use CE marking in the for goods placed on the UK market until 2022, I think January 2022. We've got a very interesting question from Cordula about whether the UK border, or whether the UK logistics industry has the capacity to be processing the additional declarations. The UK government has been very keen to try and help businesses finance adding additional customs brokers, so the encouraging hiring of more customs brokers. What we have seen, it's been a bit of what comes first, the chicken or the egg, so that we've seen the freight industry, it knows that it's going to need additional people in the event, once the UK leaves the EU and we file customs declarations. But for a long time we've been very uncertain about that end outcome, and so what I saw was even the likes of DHL saying to their customers, well, we're not going to hire additional staff till it's absolutely clear what the end position is, and even where we do that, we're going to expect you to fund hiring of those staff in advance. So they've been very cautious about not taking on additional cost, and I think some of the government grant was intended sort of to try and persuade the likes of DHL to actually just go ahead and hire additional people. And I think because it's been so unknown, I think there's just been a bit of reluctance of the industry to move particularly quickly. And then even within HMRC itself, they're obviously going to need extra bodies on the ground just to monitor and ensure and to be looking at compliance and answering all the questions that businesses no doubt will have. There's a question on triangulation. So we have a German subsidiary, and which we drop ship direct to the customer. So what I would say is, we're under trade agreements and under customs arrangements that look at the flow of the physical goods, less about the invoicing arrangements. So where you don't have necessarily a cross-border movement of goods, but you do have your subsidiary, which we drop ship direct to the customer. So I think there it will depend. I think the question I would say would be, as well, is where you have multiple parties in a supply chain, is to be very clear about which entity is going to be act as the importer of record. So in this particular scenario, I think what they're saying is, you invoice your German subsidiary, who invoices in turn the customer. Actually, the goods move directly from your manufacturing site in the UK to perhaps your customer, to the customer in France. And there I'd say the question is it going to be your French customer or German subsidiary that's going to take on the compliance process in the EU, at the EU border? So that could be at the port of Calais, for example. And I think that will be largely dictated by your terms of trade, so your Incoterms. So I would suggest that you go and look at your customer agreements to see if there's anything specifically in there that says which party takes which party takes responsibility for which part of the supply chain. I think we've touched upon inward process relief, so that's covered. Data transfers from the EU to the UK. Again, that's a question that I know that within our firm we have data specialists. So Steve, if you don't mind, we'll take that one away with us, and if perhaps you could drop Olivia your contact details, then we can come back to you on that point. Sorry, Sean, do you want to carry on? I'm just conscious we're getting to our time limit.
No problem. So yeah, this is just the end of the section on the key steps of GB importers. So a good time to fill in there. So I think the key decisions come. I'm pointing at my screen, which is not how this works. Are whether to defer import declarations and tariff payments or make them in January, and decide whether to make declarations yourself or whether to appoint an intermediary to do so. But the first thing you need to be doing is getting a UK EORI number so that you can register to make declarations in the first place. The export procedures are slightly more streamlined, and essentially what will happen is exporting to the EU will be the same as exporting to any other country outside of the EU at the moment, with a slight wrinkle that if there is a UK-EU free trade agreement, there will be the preferential origin piece that we discussed earlier. So yeah, from 1st of January, GB exports to the EU are third country exports, which requires 2 customs declarations, a UK outbound declaration and an EU inbound declaration. An EU tariff may be applicable if there is no UK EU free trade agreement saying there isn't, and depending what the product is. And again, sanitary phytosanitary checks will be applicable on animal plant products. So other key changes are on those controlled goods. So currently when you move dual use goods, for example, between the UK and the EU, you don't need the same export license that you would need if you were coming from a third country. From January, you will. So there's these kind of additional measures to bear in mind if you are involved in the export of those goods to the EU. And as with importing, the responsibility of the GB party to the transaction will be determined by contract terms you have in place, the Incoterms between yourself and the EU importer. So if you're on ex-works terms, that's the minimum responsibility for you, and delivered duty paid is the maximum responsibility for you. And irrespective of those terms, you should be maintaining, as before, proof of export and the relevant documents to show what you've been exporting and support customs declarations. Other relevant considerations, the one that Ursula touched on earlier was ATA carnets, and when you're moving goods for trade fairs in the EU, you can take advantage of these to not need to pay customs duties for temporary movements, less than 1 year. And for excise goods, that as a UK regime essentially continues as was, but there are some suspension regimes in place. Again, quite similarly, the first step for a GB exporter is getting that UK EORI number, and then it's to borrow the government phrase of check, change, and go. So check that you've got the licenses you need in place. Check for things like, do you have the relevant CE markings to be able to export your goods to the EU, and decide who will be taking responsibility for complying with customs formalities at the point of export to the EU. And here's just a kind of standard kind of cut out and keep trade checklist to make sure that you've thought about all the aspects ahead of the expiry of the transition period at the end of this year. I think I'll move on to questions. I'm conscious nothing has come up on the the chat while I've been talking, but I don't know if anybody has anything they want to raise now by unmuting or typing away. I'll take the stunned silence as a no. So thank you all very much for listening. Olivia, you said you will be sending around these slides to the attendees after this as well, and that they will contain our contact details. And I'll just show you our lovely zoomed in facial photos there for you to be scared of. So you can come to us afterwards if you have any follow-up questions.
Thank you, Sean. Yeah, I absolutely will share the slides round to everybody. I did just notice, I don't want to embarrass you in case you did it by accident, but Helen, have you just come off mute? Did you want to say anything? I just noticed you've taken yourself off.
I was going to say, to be helpful, I could cover the data transfer question if you'd like me to.
Yeah, if you don't mind, that would be brilliant. Thank you.
Sure. So, I mean, just to introduce myself to anyone who I've not met. So I'm Helen Davenport. I'm also from Gowling. I'm a partner in the commercial litigation team, and I head up our data privacy and cybersecurity team. So when the question on data transfers came in, I thought I could pick that up. So, so what about the impact on data transfers from the EU to the UK in case of a no-deal exit and no equivalence decision? And Steve, in asking this question, it sounds like you have appreciated that the benefit that we have at the moment with the EU is that we can transfer personal data freely around between all of the countries of the EU and indeed the EEA with no restrictions. But in the event of a no-deal Brexit, we will effectively become a third country for the purposes of the EU and legislation like the GDPR, and we will not have on day one an adequacy decision. So we would need the EU to say that our country is adequate in terms of receiving personal data. If we don't have that adequacy decision, and it takes some time to get them, so recommendation is to assume it will not necessarily be available, then the issue is not if you are transferring personal data into the EU, but the issue is if you want to receive it in the UK from an EEA country, or also from Iceland, Liechtenstein, or Norway. And what you should think about is putting in place standard contractual clauses, and there is guidance on the ICO website about those. The only caution around putting in place standard contractual clauses is there has been a recent decision involving Mr. Schrems and transfer of data to the US, which has said that standard contractual clauses are okay, but you need to be careful that the country to which you're transferring will effectively not make inroads into what those standard contractual clauses are. So between now and the possibility of a no-deal Brexit, we may see some criticism of the way in which we handle personal data in the UK. So the advice at the moment is standard contractual clauses, but as with all of these things, watch this space.
Thank you, Helen. Hopefully that addressed that question then. And whilst we've only got 5 minutes left, have we got any other questions from anybody in the group? Okay. I'm gonna take that as a no then. Nobody trying to get my attention who's got their camera on. So I think, oh, definitely not a question that I can answer. Question from Scott, if somebody can answer that one. Ursula, yeah.
Yeah, thanks, Scott. If you go to the HMRC website, you'll find that they have their tariff for 2021 published online. So in the event of there being no UK-EU deal, those tariff rates will apply. Equally, they'll apply to trade with any other third country. They're broadly similar to the EU rate, current EU rates. There were some adjustments. So where, for example, we used to have 0.5%, they've rounded those down. So the overall effect is that we've lowered the duty rates very, very slightly from the current EU rates.
Scott's nodding. That's it. Thank you. Okay. I think just to round up then, guys, I think if we're all done, if there's no more questions, just a huge thank you then to Ursula and to Sean and to Helen for pitching in at the end, for sharing all of their knowledge, all of their wisdom. Really appreciated. I hope everybody got everything they wanted to out of the webinar.